Are you feeling overwhelmed by taxes, uncertain about your business finances, or worried about protecting what you already have built? Well, you're not alone, and there's a better way. I'm Ashley Freeman. I'm a tax and asset protection attorney, and this is Tax and Money Mastery, where faith meets financial wisdom. Each week, I'll show you how to legally reduce your taxes, manage your money with clarity, and protect your business and personal assets so that you can focus on what truly matters most: God, family, and career. Proverbs 10:22 says, "The blessing of the Lord makes one rich. He adds no sorrow." So grab your coffee and settle in. This is a podcast you can't afford to miss. I'm Ashley Freeman, your host. I'm a tax and asset protection attorney. And just a disclaimer, while I am a tax and asset protection attorney, I'm not your tax and asset protection attorney. So everything I say today is for educational purposes only. And make sure if you hear anything that interests you or you want to know more about, make sure you run it past your tax professional who you use. If you don't have anybody, that's fine. Contact me at taxandmoneymastery@gmail.com. All right, let's get into it. So today is short-term rental tax loopholes and how the wealthy use them to decrease their W-2 income. So let's jump right in. Most people call it the short-term rental loophole. As a tax professional, we hate the term loophole, but it's true. It kind of is what it is a loophole. A short-term rental is kind of the wealthy's best kept secret. We utilize them to lower W-2 income. And there's no reason that you can't either. You don't have to be wealthy. This can work for anybody. There's a difference between short-term and long-term rental. The difference is a short-term rental is defined as the average stay being 7 days or less, or 30 days or less with substantial services. And we'll get into that a little bit later. A long-term rental is anything over 7 days average with no services or anything like that. A long-term rental is going to be considered passive pretty much. Okay, so they're two totally separate things. Get them separated in your mind. Think of the short-term rental like a cookie business. You have to work in it to make money. So the short-term rental, the average stay, how to figure out the average stay is take the total number of guests that you have and the total number of days and divide them out. If the average is 7 days or less, you're good to go. If it's more than that, then you need to provide substantial services. Substantial services can be things like you're offering them a package to the airport. You're preparing them breakfast, kind of like the old B&B's breakfast, bed and breakfast, where you prepare them the meal in the morning. You could offer them a chef-prepared meal for your Valentine's Day special, things like that. You could offer them cleaning laundry services, dry cleaning, that you would, send stuff out to the dry cleaner and get it back for them. So those are substantial services. So the first thing you want to do when you get a short-term rental is get it into service as quickly as possible. What do I mean by in service? So in service means that it has to be available for rent. So it can't be like a pigsty that doesn't have a bed in it. It needs to be available and ready to be rented. And it needs to be listed for rent somewhere, anywhere. So when you list it for rent, you want to keep a copy, take a picture of it online or something that'll kind of date stamp it so that you have proof in case you ever get audited of, no, I had it in service on this date and here's the proof. Getting it into service. So another trick that I tell people, I've had like 6 Airbnbs, short-term rentals myself. And so what I would do to get it in service as quickly as possible is I'd get 1 bedroom ready, get some things in the kitchen that somebody could cook with, get a couch in the living room, get the bed up and made and everything, and get at least 1 bedroom into service. That way it's considered in service. And I always rent it out by the bedroom also. There's reasons for that. You don't have to do it. Depends on the area that you're in. But the area that my property was in wasn't the greatest. It was downtown Grand Rapids, Michigan. And downtown Grand Rapids isn't all that in a bag of chips. So it's nice, but it's just not. And the houses were very, very nice. They were brand new. They were beautiful. But still doesn't command top dollar. Some of the people I would get would be questionable. But anyways, I actually made more money by renting it out by the room. Plus, it deterred people from wanting to have parties. I had a couple of people that had parties, and you just don't want to go there. We can talk about that in another video. So that's getting it into service. Okay. And so even if you're in the midst of working on a bunch of stuff to get it into service, what I would do if I was working on it was I would get all the junk out, all the stuff that I was using to work on things, whether it was drywall knives or whatever, hammers, nails, all that. I would get that all out of there and get the pictures taken so that I could get it online as quickly as possible. Then I could get the pictures taken, and then I would go out to like the living room and I would move all the junk out of that area, get my pictures so that I could get it all online. And then as soon as somebody booked anything, if I still had stuff laying around, then it was time to hurry up and get it out of the way. All right, so that's kind of fudging on the pictures, even though you're still working on it. All right, once you've got it in service, material participation is next. Material participation is basically anything you're doing to work on the business in the house. It can be painting, it can be cleaning, it can be mowing the grass, shoveling the snow. It could be emailing your guest, hey, here's your password to get into the Wi-Fi. Here's how you get in the door. All those things would count towards material participation. Now, the nice thing about it is your spouse's hours can count towards material participation also. So you've got to have greater than 100 hours, but no less than anyone else. So what that means is if you have a maid, or a housekeeper, I should say, better term, and your housekeeper has 105 hours, that means between you and your spouse. Okay, so if you've got a housekeeper that has 105 hours, then between you and your spouse, you need to have at least 106 hours. A way to get around that is just hire 2 housekeepers and split the work between them. It also would include like any contract laborers. So if you know that you've got like a major project, something that needs to be done, you got some plumbing that needs repairing, and you know it's going to take a while, you kind of got to keep track of other people's hours. That's how this works, unfortunately. So split it up between 2 plumbers. And it's not, if you hire a company, Joe's Plumbing, it's not Joe's Plumbing overall that you would count the hours. It would be the individuals from Joe's Plumbing that came to work on it. You would count each of their hours individually. All right, so that's how that goes. So like if you have a partnership with an outside person that's not your spouse, only one of you is usually going to be able to get material participation because you have to get more than the other person. So that doesn't work very well. The other option for material participation, actually there's 7 tests, but we only use like 1 or 2, maybe 3. The other option is to get 500 hours. And if you've got 500 hours, then it doesn't matter how many hours anybody else has. If the maid had 600 hours over the year and you only had 500, it didn't matter. You still meet the material participation guidelines. All right, that's material participation. Then what you're going to want to do is you're going to want to do a cost segregation study. What a cost segregation study does is it segregates or separates out all the different items within a building. So normally people take depreciation on a building like either over 27 and a half years or they take it over 39 years, 39 years if it's commercial. For when you're using it for a short-term rental, it's considered commercial. So without a cost segregation study, you would depreciate the entire building and everything in it over 39 years. So what a cost segregation study allows you to do is it separates out all those things because everybody knows carpet does not last 39 years. Carpet lasts 5 years. So it separates all those things out into 5, 7, 15, and 20-year property. And with bonus depreciation being 100% right now, it will allow you to take the 5, 7, and 15-year property all in that year. You would still have some depreciation left of the 20-year property, but you get to take the majority of it up front. What does that mean for you? A huge deduction. And since you met material participation and all these other things, you get to use it to offset your W-2 income or capital gains income. That's huge. That is why our high income W-2 earners use this, because they can meet the 100 hours material participation quite easily, and the cost segregation study, you don't want to have the cost segregation study done by somebody who's not experienced and qualified. You want to have it done by somebody very experienced. A place that I like is called Cost Segregation Authority Partners, and they're fabulous. Every one of the reports I've seen is pristine. They have engineers, they have CPAs, they do it right. They've never lost an audit. At least their portion, if someone was audited and the person had a cost segregation study on it, the cost segregation study went through with flying colors. They may have been had a problem with something else, but not with the cost seg study. So that's how that works in a nutshell. If you have a long-term rental, it's a totally different criteria that you have to meet in order for the cost segregation to be utilized and to offset your W-2 income. We'll talk about that in another podcast because, like I said, it's a totally different criteria. But this is short-term rentals. So get them into service as quickly as possible, an average stay of 7 days or less, or 30 days or less with substantial services. Materially participate greater than 100 hours, but no less than anyone else, and do a cost seg study. Now you have, on the cost seg study, you have until your timely filed taxes for that year. So if you did one this year and you met all the guidelines and everything, but cost segregation place doesn't have room to get you in until next year, like maybe February, excuse me, you have until April 15th to get that cost segregation study done. Or if you timely file for an extension by April 15th, that would give you until October 15th to get the cost segregation study done so that it could be turned in with your taxes. All right, that's all I've got today. So if you have any questions or comments, please feel free to leave a review, or you can contact me at taxandmoneymastery@gmail.com. Thanks. Hope you're having a great day. See you next time.